All right, so today we're going to talk about section 3 of chapter 4. This will be the last section. It's not too terribly difficult here. Talk about government regulations on credit. So the first one I want to talk about is called the Truth in Lending Act of 1968. This requires creditors to keep consumers fully informed about the costs and conditions of borrowing. This is where when you get a credit card, you're going to get a lot of papers with it that's going to have a lot of information on it about what the credit card does, what the what's allowed, what is the APR, and et cetera, et cetera, et cetera. So this is them basically telling you the truth about what's going on. Next one's called the Equal Credit Opportunity Act, or ECOA. This was in 1974. And this says you cannot be denied credit because of your race, religion, national origin, gender, marital status, or age. I know it's hard to believe, but before this ECOA, many creditors would not approve a married woman for credit unless her husband also signed the application as well. Now only joint applications require the signature of both spouses. So think about that. It wasn't too long ago, 45 years ago, that basically, women, if you're married, you could not get a loan unless your husband would sign the application with you. So again, this is, to hopefully let everybody partake in the credit opportunities that are out there. Next one's called the Fair Credit Reporting Act of 1970. This protects the privacy and accuracy of information in a credit check. The Fair Credit Billing Act of 1974. This sets up a procedure for the quick correction of mistakes that appear on consumer credit accounts. So again, if there's a mistake on my credit account, I call to get that corrected. It'll happen quickly. It's not going to take weeks or months. It should happen rather quickly. The Fair Debt Collection Practices Act of 1977. This prevents abuse by professional debt collectors. Does not apply to banks or other businesses that collect their own accounts, just abuse by professional debt collectors. And then the last two things I want to talk about in this chapter, usury laws. These are laws restricting the amount of interest that can be charged for credit. States have different max rates. Sometimes they're 18%, maybe they're 20%. So that's just the usury law where the max you can be charged for credit. And then the last thing I want to talk about is personal bankruptcy. This is where debtors must give up most of what they owe, which is distributed to creditors. So again, the debtor would be you as a consumer. If you're borrowing money from a bank or somewhere that's a creditor, if you file for bankruptcy, you're giving up what you own and then distribute it to those creditors that you owe. This does remain on your credit score or your credit record for 10 years. Therefore, it'd be more difficult for you to get credit in the future. And of course, Uncle Sam's going to come get his money. Congress can still collect taxes. So even though you file for bankruptcy, the U.S. government is still going to collect their income taxes, federal income tax, state income tax, all they can to make sure they're getting their money. So that's a last resort. Obviously, having any of that bankruptcy is not good. It's on your credit record for 10 years. Going to be hard to get a loan if you have filed for bankruptcy. And that's it.